Well, as the market continues to move higher, so have valuations, with the S&P 500 now close to crossing its 5-year average. Could that be signaling that the rally is getting stretched? Joining us now is Lori Calvasina from RBC Capital Markets. Lori, good to see you.
Thanks for having me.
So obviously valuations are kind of reinflating, but not back to where they were, I'd say, last fall. Earnings themselves, I guess you have to check off that box. So when you do the building blocks to where the market goes from here, what are you mostly looking at?
Look, I think generally it's climbing a wall of worry. I think that the earnings dynamics are extremely important here. And I know a lot of people in the geopolitical community think equities just don't get it. I would counter that. I think maybe perhaps people in the geopolitical world don't understand what's happening with the AI trade and earnings and how much of a buffer that is for S&P 500 EPS. So we're continuing to see rates of upward revisions that are positive on that AI-related trade. If you look at the mega cap growth names in the market, we are seeing, less rosy conditions in the rest of the market, but the strength of that AI part is really helping. And as a result, when we look at the market cap weighted PE, it's not moving up that fast. So I think by our last count, we were around 25 times. The highs last year around 28. If you look at it on a next 12 months, next 12 months basis,
yeah, okay.
Just a bottom market cap weighted PE. And so we think there is still room. And we also look at the Russell 2000 PE, which is a very good broad market barometer. It's only around 16.6 times or so as of last week, and it can get up to over 18 if you look at the past couple highs. So I'm not saying there's a ton of room before we have a little bit of a breather, and we don't think markets move up in a linear fashion, but I don't think we're overheated right now.
The strength, though, in earnings growth, the strength in the S&P 500 is really the AI trade.
Yeah.
It is the tech trade. So how do you sort of think about the impact of the oil shock, the energy shock, maybe longer, higher for longer inflation on the rest of the market? Are there areas of the market you say, okay, we like the AI trade, that's going to fuel us higher, but we will absolutely stay away from this because the impact from the energy shock is going to be definite?
Well, it's funny. I've actually been underweight consumer discretionary for a long time before this war even got started. This was one of our big underweights coming into the year. So we feel like we've already checked that box. Consumer staples is one that doesn't score so well in our analyst survey that we did recently, where we asked our analysts all these different questions: valuation, demand, war impacts. But the sector's actually done pretty well. So we've got a little bit of a defensive, undertone to that. I think as we go forward, defensives, they don't necessarily look all that appealing as a whole, right? You have expensive valuations in utilities, concerns about affordability that may show up in the midterms. Consumer staples obviously has some overhangs, and healthcare, I like it, but it hasn't worked this year as a call, right? It's one that just can't seem to get out of its own way. So I think when the defensives, are either giving you some challenges, you do have to look for those kind of rebound opportunities or for bargains within cyclicals.
You mentioned a wall of worry, obviously probably not as tall as it was 5 weeks ago.
Yeah.
But in communicating with clients, are they kind of reluctantly participating? Are they fighting it? Do they not like the leadership of the market?
So it's funny. I mean, in the weekly we put out on Monday, I characterized everyone I met with last week as a little bit cranky. And I think part of it is just the fatigue of the year. If you talk to small cap investors, they tend to be biased towards quality stocks, and those aren't outperforming right now. It's more of a lower quality bent, so that has them in a bad mood. And if you think about, the last couple weeks as we continue to creep to these new highs in markets, on the one hand, I only counted one investor last week who told me he's worried about a recession, and I can't even think of any in the couple weeks prior to that. But at the same time, there's a little bit of a disbelief, a little bit of, do we really need to be at all-time highs? So I think investors are still kind of navigating this foggy bottom, trying to figure out exactly what the impacts are. And they're hearing a lot from the geopolitical community about kind of these worst-case scenarios. They're hearing an opposite message from the companies who are really saying, we've got this, we can manage through for now, we have buffers. So I think there's a little bit of confusion, to be honest, Mike, that's contributing to some of that crankiness.
You see the S&P 500, though, 500 points higher from where we are right now in 12 months. So it's the rolling forward price target. It's not going to be linear, though. So what sort of are you predicting a pullback? Are we going to sort of hit the point where investors do grapple with the energy shocks, inflation concerns, et cetera?
So I think when you talk about earnings, you have to talk about the AI-related earnings and the non-AI-related earnings. And if you look at what's happened since the war began, we've seen a big uplift in the energy sector expectations. Materials has also moved up, and of course, tech and Mag 7 and the whole AI story. A lot of other things have stayed relatively flat. I do think outside of that AI trade, you've got buffers, you've got inventories, we've got hedges. I think companies are doing a good job managing through, but the longer and longer this goes on, the less robust those buffers are going to be. So I've told people I feel okay about 2026 numbers for the most part. 2027, is there going to be some risk there when some of those buffers run out? Perhaps at some point we need to downwardly adjust some of those expectations. That could cause some ripple effects in markets. I don't think that it's anything like recession pricing, but it could give us some indigestion.